And we're back with another episode of Pure Perspectives. I'm Clark Alexander. I'm sitting down with Willis Richardson. How we doing, Willis?
I'm doing great. Doing great.
Creeping up on Thanksgiving.
It is. It's getting nice.
Right
Still
around the
hot
corner.
here in Texas.
That's what I heard. Like
It's
90?
Yeah. Basically got up to 86
I
for
don't crave
Thanksgiving.
I don't crave turkey when it's 90.
No, it's something that it's one of those foods that it has to be cold outside.
It has to be cold.
Yeah.
Yeah, it just doesn't work. Well, today, first some housekeeping. Smash that like button. Give us a subscribe. Leave us a comment. We love to hear from you. Today, we are going to talk about bank statement loans, right? We seem to be getting more and more of these, and we'll talk about why that might be happening. But we wanted to lay out kind of what are the basics, how does it compare to more of a conventional loan, what you can expect in the process, and what you need to have available in order to execute a loan like this. So why don't we start with the very beginning? What exactly is a bank statement loan, and who's it designed for?
Yeah, so it's designed for self-employed borrowers, so you do have to be self-employed. And what it does is traditionally conventional loans, you sit there and we look and analyze your tax returns. Well, sometimes you might make a lot of money, but you also know how to pay a lot less in taxes. And so you show all the costs. You bring that taxable income down to something very low. Well, for a conventional loan, we have to prove you on taxable income, not your gross receipts. And so it can drastically change what you're going to qualify for. So a bank statement loan goes in there and we look at all your deposits over a 12-month period or a 24-month period. And then we divide that number by 12 months or 24 months. Now, we also have to apply an expense factor, and different lenders that we work with have different standard expense factors, but a good industry standard is 50%. So to give numbers, if you have 200,000 in deposits over a 12-year period, and we do take out anything that's a one-time deposit, they have to be business-related deposits, then we apply a 50% expense factor, which would give you 100,000 in income, and then we divide that number by 12. That gives us your monthly income, and then we approve you based on a debt to income ratio with that monthly income number. So it allows people to apply or to qualify for a lot larger home than if we were going off their tax returns in most cases.
Got it. And I think that answers my next question is like, why are traditional mortgage guidelines often a challenge for self-employed? It's really just that, right? They're self-employed, they have a business, they make money, but there's obviously some expenses and some tax write-offs that are eligible for that business owner to take advantage of. Therefore, we can't. It's not a W-2, right? It's a different scenario. So we have to look at it as a business owner. What are their deposits, and then the expense factor? You said that varies by lender, correct?
Yeah, it varies by lender, and then even within each lender, if your CPA will write up a letter saying, well, his expense, let's say they're an auctioneer. I don't know. An auctioneer doesn't have a lot of expenses. They're providing a service. Service industry, self-employed borrowers typically don't have a lot of expenses. So CPA can write a letter saying, well, their expense factor is 15%. Their expense factor is 20%. So instead of taking 50% of their income, we would take 85% of their income or 80% of their income, whatever that ratio comes out to be. So we get to even use more income in those cases. There are some industries. I actually did one for a couple that owned a produce stand. Well, they actually had to apply a 70% expense factor because costs in that industry are a lot higher than your retail or your service industry. So each industry can be slightly different. I really have only run into that one that only happened one time.
That it was that high. Yeah.
98% of all other loans, besides that one that I've done, we usually get them approved with a 50%. And I will say, it sounds pretty easy. Your CPA just has to write this letter. Sometimes getting a CPA to write that letter can be a little difficult. So good rule of thumb is 50%.
Yeah, and if you're having trouble or don't quite know how to ask your CPA, we're certainly happy to help with the language and get that request written up so you're getting the right answer the first time and you're not having to chase down your CPA for edits and what have you. Can this be used for both purchase and refinance?
Yep, we can use it for both purchase and refinance. We can do it for a cash out refinance if we needed to. Maybe your company needs some liquidity to be able to get through the last quarter. We can do a cash out on your primary home or in investment properties as well. But there might be a better option for investment properties. So
yeah. And then you see, typically somebody that went from W-2 to self-employed from 1 year to maybe in 2024 they were W-2, 2025 they're self-employed. Is there a historical factor we need to be counting in here just from a deposit standpoint?
Yeah, so typically most lenders want you to be self-employed for 2 years, and you're going to have your CPA write a letter saying that you've been whatever percent owner of the company that you are, that you've been that for 2 years. So even if we don't need them to change the expense factor, we still are going to need a letter from them saying, yes, you have been. Because normally we would ask for your tax returns to prove that you've been in business 2 years, but we don't even look at the tax returns on these loans. So you do have to be in business for 2 years. Now, that is with an asterisk. We have a lender right now that will, as long as you've been in business more than 12 months, we can do a bank statement loan with.
Okay.
But in general, bank statement loans, you have to have been in business at least 2 years.
Okay. So people that are, business owners that are thinking about this as an option, what should they prepare now? Like what documents, what should they have in order to come in, get an application and get the ball rolling?
So really, we just need 12 months of bank statements.
Full bank statements. And by full, we mean every page.
Every page. So if you go to your online banking and go to the statement section, just download the last 12, then we'd have you fill in an application, upload them into there. We do have to do a credit pull and make sure that your credit score is high enough to do it, which with different lenders, there's a variety, but you definitely need to be, I think the lowest we can go with one of our lenders is 660, but don't quote me on that. It might be 680. And so, we do have to pull credit and you have to have the bank statements. And then we actually send those off to the underwriter. The underwriter calculates. And so once we have those statements, we know what your income is and we know what we'll be using to qualify you with.
What if some of the capital is tied up in investments?
Well, it doesn't matter where the capital is. What we're looking at is the deposits into your account.
So it's inbound.
So, right, it's just inbound. So, and you do have to be careful with these kind of loans. Like, let's say you have some kind of retail outlet and you bring in $300,000 a month, but you also have to buy new retail or new items to sell, and that costs $1,000 a month. Okay. Well, we're just looking at your inbound income. We could technically approve you for a payment you might not want. So there's a little bit of counseling that we need to do when we're talking about this, because you can potentially, based on how your company is structured, you could potentially qualify for something that
way over your tips.
Way over what, you'd be out over your tips, and you don't want to necessarily be there. So we definitely talk a lot about where you would feel comfortable with a payment, especially if you're somebody that is bringing in a lot of gross receipts.
Got it. All right. So we need bank statements. We prefer that you're in business for 2 consecutive years as a self-employed individual. Really, all we need is full bank statements. There's really no other documentation that's needed. The credit requirement is the same. We will run a full credit report and use the middle score that comes back. And any other curveballs or anything else that you've experienced that people should be aware of when taking on this type of loan? I think probably what you just said is, hey, you can get to an uncomfortable payment or approval for an amount that might be stretching you a little too thin. So definitely there. Is there anything else?
Not really. Some of our lenders have reserve requirements that you have to have. So if your monthly payments $3,000 a month, you might have to have 3 months reserves. It just depends which program we're going with. So that is something that can happen with some of the programs. Now, that doesn't mean when you have a reserve requirement, that doesn't mean that checking account or savings account is tied to that loan in any way. They just want to know that if you had a lean month, if it was a lean month, that you could make the payment. Now, after the loan closes, if you want to go and buy a boat with that money, have at it. I don't know if that's the best financial decision,
and just invite us.
But it isn't. Yeah, exactly. It's not tied to the loan. You're not going to mess something up. It's not like you cannot touch that money.
Got it. Yeah, it's not really used as ongoing collateral for the loan.
Right.
It's just proof that the reserves are there. You
Mm-hmm.
have the reserves in place to pay this monthly payment going forward. Got it.
Yes, sir.
Awesome. Well, very, very informative, Willis. I think this is going to hopefully open the eyes of some self-employed people that maybe think that they're not able to come in and secure a mortgage. So if you have questions, if you are self-employed and you want to look at a specific scenario, reach out to a loan officer here at Peer Funding. We're happy to walk through the math, see where you stand, also guide you on what might be the most comfortable payment based on the numbers that we've seen over the past 12 or past 24 months while you've been in business. So we're here to help. It's another option: conventional VA, FHA, bank statement, DSCR for investors. We have quite the potpourri of loan products. So get in touch with us and we're more than happy to help.
A plethora
Of loan products. Willis, thanks as always for taking the time. Informative. We appreciate it. Reminder, everybody, reach out. We'd love to hear from you. Give us a comment. Smash that like button. And if we don't talk to you before Turkey Day, have a great Thanksgiving.
Bye. Happy Thanksgiving.
See you, everybody. Happy Thanksgiving.